welcome to an episode of Money in the Bank with Frank. Right now I have Christopher Friedl with us. Why don't we, before we introduce Chris, why don't we go ahead and run through the fun that is the small print. The big print giveth, the small print taketh away. When we met the very first time randomly down in Austin at that convention, you said University of Dallas, and I was like, no one goes to the University of Dallas. It still is around here. I was like,
you mean UTD?
Right? Like, did you think UTD? And you're like, no, UD. And I was like, wait, what?
Yeah, that is the reaction, right? It's like UT people are like
you went to
UD?
UTD?
I'm like, no. It's like SMU, but without the connections.
Yeah, it's like SMU, but with a worse library. You know,
right. This is true. There's a few other things that it's short on as well, but hey, it's great on philosophy. It's great on foundation.
I cannot tell you, as someone who is an adult that had undiagnosed ADHD, the fact that I landed at that school with such a small, student to teacher ratio was critical to my success.
Yeah.
Having gone to school in Plano East, the Plano district from elementary all the way through high school, I got by with that, I did no homework, but I tried to pass every test so that I would pass, right? Because I couldn't, I learned different. But I did think I was stupid, right?
Yeah.
But thank God for UD, because I got there and then I learned. And I even made the dean's list.
I did not know that you made the dean's list at UD. Yeah, it is great. I mean, it's one of those things where I remember having this class with a philosophy, literature class, and you went through and I had to write an essay, and it was like, interpret this. And I was like, oh, I can, you just make stuff up.
Yeah.
not make stuff up, but you're drawing connections that, you're drawing all these connections together that when you have these standardized tests, so much of that just gets lost, right?
Yeah.
If you've got that ability, on that creativity side, it just doesn't capture it.
And that gets to those tools that we were talking about earlier.
Yeah.
It gets to those tools as far as what I didn't know was that actually gave me the tools to come up with other critical thinking decisions. Like I'm a degree in history, and here I run, a multi-million-dollar portfolio management firm. So
how have you seen that impact it when you're looking for new deals, when you're analyzing deals? How has that helped you as opposed to some of the standardized?
I think, I'm what's known as a macro guy. Right. So I know that my strength isn't taking a look at the actual balance sheet and doing bottom up analysis on an individual security. I'm I can look at some trends on charts and kind of gives me a good gauge on some stuff, but I like to look at what happened in the past and pattern wise, right? Like a lot of times when I got my degree in history, people are like, well, what date did that happen? I'm like, date wasn't the important part. It's like what led up to it or what was important.
What were the dynamics that created that situation? Yeah.
And what was the situation? It was like, in the Civil War, there was a battle that was fought after the treaty was signed because there was no communication. They didn't even need to die, And those are the kinds of things that you learn. It's like, well, how do I equate that to the stock market? Well, you look at different things. Like, is math right? Is math wrong? Is this emotionally driven? We're about to see the most amazing thing happen at the close of the market when NVIDIA announces their earnings. One company announces earnings, and we're going to know whether or not this has depth, and maybe these larger cap tech companies are going to continue to run, or is there going to be a breakdown? And a lot of people are saying, you take a look at what happened yesterday in Tesla. Tesla and NVIDIA, both of them at some point ran up $120 billion. That's over the market cap of CBS in two stocks. Does that make sense?
How much of it is the emotional drive and and how much is the fundamentals? And it's one of those things where the fundamentals, it's like that, the rubber band, it goes out, but it eventually somehow has to come back. But how long can the
absolutely
insanity last?
Wrong. It could go up a lot longer than I'm right? So the whole idea though is that what history helped me to do though was to be able to believe in my premise, based on what I see and what I think is happening. Now, whether I'm right or wrong, the numbers will show, but I at least get that.
Yeah.
And it gave me a good base to start figuring out what it is that I think is a trend or what I think is important. Like, you know, when the .com crash happened, yeah, a lot of these companies went down. That was multiple compression. I was too young to understand what that meant. Now I understand that.
Yeah.
And so when I see it happening again, but again, my job is not to be right. It's to make money. So you have to balance that too.
You know, when you're looking at history, I think, you know, so much of this latest bull market's been going on since, you know, 2009, 2010. So, you know, a lot of people that are in the space, they just haven't known a huge bear market. They have not known a huge drop. I mean, even COVID was a quick drop, quick back up. And so I think when you're studying history, if you're appreciating you're appreciating that how much things can drop and how things relate, it allows you to protect yourself so that you do stay alive for tomorrow. You'll stay alive to be able to fight again tomorrow.
Oh, for sure. I mean, you know, to further that point that you have, I have a good friend who manages a, you know, pretty good chunk of money in a fund. And when we knew we were going to get along, when I asked him the honest question, which was like, you know, you've been managing money since 2000, or you got out of school in 2008. Interest rates have gone up. What are you going to do? And he was like, I don't know.
I have no idea.
I've never seen this before. I just graduated from high school when that happened. And I see that, you know, I mean, people live in corporate America at the same job for more or less 4 years. Then they move to another company and they move to another title and they do another role. So I'm really curious to see how this happens and what happens. And, you know, we do, thank the Lord, have some pretty fortress balance sheets. So people's need to borrow is going to be a lot less. And I think a lot more companies will be fine. You know, they may get trimmed and valuations may adjust. But there's definitely going to be some companies that probably suffer more. I mean, I think it's no surprise, and this is not news, that regional banks are probably going to be hurt pretty bad by commercial real estate.
Yeah.
But then again, in the other real estate markets, there's a lot of opportunity. Everyone wants to live in a house. Everyone wants to have their own home. Right. So
that was my next question of what you see on the commercial real estate front. What are you seeing? What are you hearing out there?
I am hearing horrible things, right? You know, I'm hearing that Blackstone in some instances, I've heard that, you know, they're throwing the keys back at the banks on some of these properties. Like if you listen to the All In podcast, they actually mentioned, I guess it was David Sachs who mentioned that he got horrible terms and it was supposed to be a good deal. So effectively, you know, he owns a building and we'll say it's worth $15 million and he's got a $9 million commercial note on it. And the terms that they said is that we'll give you a loan on 2.4 and then we want you to pledge your personal securities as collateral for the rest, which is effectively giving them a margin account. Right. And that apparently was good terms. Now, he's just going to write a check and pay off the building and refinance whenever things solidify. But how many developers and how many banks and how many big commercial real estate people are going to be able to write that check?
Yeah.
Right.
How many are running funds that are, you know, they did a bunch of small investors that are in the deal and then they need to come back and cut that check.
Yeah.
Yeah.
And then their air conditioner breaks and they need that money back and they're not going to get it. Right. And that's when we're really going to see a squeeze.
Yeah.
But, you know, that's
who knows and how over what time period. I think, you know, it does seem that the incentives for the banks, you know, they don't want those properties back, but at the same token, you know, extend and pretend. Is that the
that only goes so far. I mean, you're really starting to see it now. The addressing has to happen now because, you know, these are some 3 and 5 year terms, and those 3 and 5 years are coming up, you know, literally right now. So we're about to really see it. And I'm sure that as a country, you know, we're rich as a country, you know, for whatever that means. So I'm sure there's going to be some kind of programs that ultimately make money for the federal government over a 20-year period, and everyone else
Extends-
fails. But
extends the power out there, increases the power.
Yeah,
and
yeah.
I think this would be make for an excellent Tuttle Twins episode.
Look, I mean, if you just take a look at that yield curve, and I mean, people hear about it all the time. I don't think enough people really understand what it means, and I really do. And I don't have the patience to explain it either. I don't want to build a clock where I can just tell you what time it is. It's bad, right? But it's coming. It has to come based on dynamics of money. If you borrowing at the short rate and that's a high rate, and like you have no risk premium, who's going to buy the long dated paper? But
I mean that's it. I mean, and it works its way out the risk curve, right?
Yeah.
So if you look at it and someone's doing, someone was looking at raising, I come out of the space from the on the hard money side, and back in the day, your rates would be, for your bank lines, you'd cast paper at 14%, you'd collateralize it at 4.5, 4.25, and you made a decent spread. Now all those notes, they're coming due from the bank, they're resetting at 8 to 9%, and then you're a lot of that. There's been a lot of competition, so the rates have gone down to 10%, 11%. People doing all sorts of fun deals, and you just look at it and say, at some point the juice is not worth the squeeze. And your alternative, if you've got a bunch of cash, you have $5 million, you can take it and park it in treasuries right now and make $250,000-$260,000 a year and not have the risk,
not pay attention to it, right? Because I mean, what's the truth of the matter is, my whole life here I've been helping people to try to save for retirement. Hopefully 4 out of 5 of them, like normal, make it without any kind of disability or health issues, and for the ones that make it, to enjoy life as early as they possibly can, right? Because it's really hard to travel when when you can't, when you're not mobile. So that's what I've always tried to strive for, was to have a good work-life balance. And you're seeing, I think, the pendulum swung so far that people were having too much life, not enough work balance, and that's going to come back to bite us, because you can only spend so much money that you don't have before you get into trouble. And then, right now there's a lot of these EIDL loans that came out. People thought that the PPP and the EIDL were the exact same thing. And so now there are these people that literally have a loan payment that's coming due, and they're like, wait, I thought this was going to be forgiven. Nope, wrong one. You picked the wrong box on the website. Sorry. It's the government. So tell me your story. Tell me your give me your testimony.
What's
testimony?
Your story? I don't know. My story is coming out of UD. Got clipped by the market. In 2009, that was my entry into the space. So I jumped into real estate, seeing all the LPs sue the GPs. That was, at the time, it was, lost a ton of money. Thought it was the worst thing ever. But, when you look at it, you get that experience, you get those scars early on.
Blood in the water.
Teaches you some risk management. Now, I think the opportunity cost that you lose over time, because you're then skittish about deploying capital. That also ends up being a fairly hefty price. I think that's probably what we'll see. My guess is what we'll see as people have taken these hits now. Their biggest cost to them is not going to be so much the money that they've lost right now. It's going to be some people who are running into this. They're going to be traumatized by it. It'll be this PTSD process where if it's something once you lose a bunch of money, you're skittish about going back in, and then if we do switch into a hyperinflation mode, or we do switch into something where it transitions quickly, you could see people where they sell all of their assets. 2009, 2010, people are selling, converting over to treasuries at the very bottom of the market, and then insurance product annuities, they're moving over into those, and then right as the market turns back around, now they've lost. It's taken them 30 years to build that up. They've now lost half of what they built over that time, and some people won't come back. Some people they'll park that way, and then they'll just wonder what happened to them.
Happened to my father. My dad worked for my father had just gotten out of Korea, and he had a couple of ducats, and he threw money into obviously much less clarity back in the 40s or 50s when he was a young man, and had a little bit of money to put together, but he invested in a gold company, gold mining company. It was the only, discretionary money, his first experience in the stock market.
And what year was that?
So he was born in 1930. So
Okay.
I don't know how old he was when he made this investment. The only
50
reason
or
I know this,
60s,
so yeah,
yeah.
the only reason, no, it was way before that. It was probably the 40s, 50s, 50s, 60s. So he was effectively like, he was an executive at the American Heart Association, but there weren't, stockbrokers weren't like they are now. They weren't easy to find. You didn't really know they existed. So I don't know how he did it. And I didn't even know this story until after I'd already started in the industry, in the financial services industry. I found this stock certificate, long dated. So of course I run the QSIP, nothing doesn't exist. And I asked my dad about it. He was like, well, got out of the war, got a job, put some money into this company. It went to zero. I never invested again. Every dollar that he had for retirement was because of his pension plan. It was because the company itself actually put money away, which they don't do that anymore.
And I mean, you see these, you see the viral clips of people finding out that their pensions are not there. They don't have those pensions. They've put in all this time, and they've done the work. Yeah, but they haven't. They've done the work, but they haven't managed their finances.
It's not funded, or the pension mismanaged the funds, right? And then you get into the fiduciary, and then you have to sue, and then there's going to be a workout. And no one ever makes the money but the attorney.
That's it. And it's funny when you're the worker, you don't think about counterparty risk of your company and the pension company that they're using.
Right.
And it goes back to risk allocation. Someone that's doing the pension, if they have 100% or 90% of their portfolio in something, and even if there's only a 5% chance of loss, you're looking at a 5% chance of a total loss or massive amount. And I think that's where a good financial manager comes in and can take that and offer that perspective. But a lot of people don't, they're not spending that time on it.
Yeah. And what's really sad is that I'm seeing at just the time where I think it's really important to have professional advice, you're seeing people like me retire. I'm actually on the young side of a financial advisor now. The average financial advisor is in his mid 60s.
Oh, wow.
Yeah. So why? I mean, everyone's got an app, right? So it's like your app is going to manage it much better. Well, to some degree, you may be right. Like, these AI models are going to get pretty good at, matching or sticking it in the S&P 500 or whatever. I get that. The value in a financial advisor isn't in the actual money management. He has access to financial managers that you're never going to be able to get into. You try to get into a Citadel without somebody being your counterparty, right? But so there's value there, but really the value is in saying, hey, Chris, you've got property in a bunch of different countries. When you pass away, how's that going to be distributed? Now to you, it doesn't matter.
Yeah.
But I'll tell you, I've never seen a family without an estate plan that actually stayed together. And I mean, like, siblings never talking to each other again, right? And there's no app in the world that's going to push you, because what are you going to do after it tells you for the third month in a row that you still haven't done your will? You're going to delete that note, that reminder.
And doesn't, yeah. It's funny, when you're looking at it from a straight dollars and cents perspective, it's like, oh, well, Wealthfront or some of these other ones can be cheaper from a cost, a cost for it. But you look at it and you have to take that's from a theoretical standpoint, though. The actual cost, the pragmatic cost is when, after you calculate in not having done the will, not having done the estate planning, not having done the risk, property capital allocation on it. And God forbid, I can't remember, it was either Mike Green or Lacey Hunt was running through the risk on the ETF side of the potential, we've got everything's been moved to these passive funds. If you have net outflows that come in right now, the volumes are a lot lower. Yeah. If you do, God forbid, you end up having a net outflow and then those values spike way down. Are you prepared as a possibility? And so a good wealth manager looks at it and says, okay, hey, here are these different probabilities. Here's all the different ones that we need, outcomes that we need to prepare for, and then puts it into your personal situation, not just some app plugging in from a theoretical number. Because if you don't calculate into your personal life situation, right, you offer that to your clients. I can come to you and say, hey, Frank, here's my specific situation. Here's the cash that I've got coming in. Here are these specific concerns that I've got.
Right.
And whether I'm rational or not rational, you have to deal with who the person actually is, not who the theoretical person is that's sitting on the other side of the table.
Exactly. And there's variations, like with those advisors. With any advisor, I mean, you've got some guys that are pure sales guys, right? It's a guy that works at some big firm that has a very mature book, and you met him at the golf club, and you say, hey, yeah, I manage money for all these other people, but what does he really do? He
sells annuities.
He sells annuities.
He's a life insurance sales guy.
Or he's going to jam you into some separate managed account where he just has to hang out and talk to you. But you could have done that yourself. Now, if that's the guy, then that's the guy that gives gives people like me a bad name. But there are independent guys out there like me that will take a look at every one of your assets and find a way to monetize it. Recently, I took on a client that is a physician, a surgeon, and he's here in the area, and he has wisely purchased. There was a medical suite out in the Prosper area, Frisco area, that right next to the new Texas Health Hospital. They've got all these medical condos there, basically, and he bought two. He took his, and he took the one next to it, because you never know, right? No, that costs him something. He had a plan for it. It fell through. It's costing him a certain amount of money per month. I recognize that. Luckily, I've worked with a lot of doctors before. And I said, nothing drives me more crazy than a dead asset, a non-productive asset. So I have a doctor flying up from a different state to come over that has a different MSO already set up for a different thing.
Now what's an MSO? You have to
medical servicing organization.
Okay, gotcha. Okay.
And so we're looking at doing a JV where he can actually participate. They'll run it. He's got the space already. He's made the capital contribution, and now it'll be a productive asset. Now, how do I value that? Like, I'm not going to get paid anything on that, right? But I am going to get paid eventually, because he's going to put more money into his accounts, which then I'll get to charge a percentage of assets under management on.
Right.
How do I put that into performance?
Yeah, that goes back to those intangibles. What is the pragmatic return and pragmatic cost of not employing somebody? And it's really just, you have an advisor,
right?
And is for some people, it's the app that's the extent of their advisor. People can't even run their own P&Ls at the end of the month to know if they are net negative on their expenses or net positive just on their W-2s.
Yeah.
So maybe some people don't think in those terms, but I think the wealthy always. You and I both know several people that have some assets, and there's always an army of people there's always an army of people that are there's trying to get a hold of them. But there's a trusted group of people that when something pops up and it's under their expertise, it gets bounced off them, and you bounce it off of your attorney, you bounce it off of your accountant, you bounce it off of your banker, and then when it comes back through it, you as you're the CEO of your finances, right? You look at it and you make that decision, and you make that call. But some people, if they're just comparing on the app, that's not going to be your guy that's trying to run his own family office.
That's right. You're never going to get to a family office if you don't do the right thing. There's steps. There's steps there. You do it yourself, you're never going to get to the point of a family office. You got to delegate. Right.
Yeah.
Right. So you came in through. So you came in 2009, just right after the financial crisis, the great financial crisis, everyone likes to call it. I like to call it a moment of sheer terror.
Sheer terror.
I will never forget my story. I was sitting on the stoop of my townhouse in Jersey City, talking on the phone with my brother-in-law at the time, who owned an RIA down here in Texas, and we spent like an hour on the phone as to what was about to happen. I had gotten a phone call from my assistant at the time, who was my cousin, now a very successful, God bless him, financial advisor at one of the bigger firms in New York. And his wife was the head of a trading desk at one of the bigger firms as well. And they were out at dinner, back as they used to do before the great financial crisis, talking about stuff. And it came up at the table that the next day, Merrill Lynch was going to start buying, mortgages for 75 cents on the dollar. And so, of course, my cousin calls me and tells me this, and the next day I sell out of every financial that we own, right? And then, fast forward, it took 2 to 3 months for that to unwind, and it was a great call, but like I knew that was the beginning of a huge problem, and that was the great financial crisis. So like, the sleep that I lost, I'm sure, clients woke up and figured out, I was like, why is my account down 3 months later? But the PTSD, as you call it, of the moment, it's like, whew, that was rough.
now you said that you waited for 3 months.
No, I think it was about 3 months before the real hurricane started. I immediately sold out of the financials.
So when you're looking at it and you're seeing,
that's what history, by the way, that's what my history degree helped me with.
Well, you answer the question before I get it out of my mouth. Is how do you handle waiting through if you have this thesis that's sitting out and playing out? Hasn't quite played out the way you thought it is, and it's month 1, month 2. Some people, it's
I'm on month
6.
12. I am short a 15% position in the queues.
So you just go, and you're going off the history on it, and then managing your position. And
I was so lucky. My brother-in-law at the time, and this is that conversation that we had, and he was like, Frank, I will get a job working at McDonald's before I sell any of these stocks that I truly believe in. He wasn't a growth manager. He was a value guy, and he really he was a bottom-up guy. Still is. Great firm. But he gave me some advice that kind of helped me through the process as well, because, I was a small independent guy working at Commonwealth at the time with a pretty insignificant book. And my clients, their money matters. So he said, Frank, I have such conviction that we're going to get through this eventually, that I'm not going to let the market dictate the stocks that I sell. And so that, along with Michael Burry and seeing, if anybody hasn't seen Big Short, I mean, geez, wow. You could if you know something about finance, watching that show is a master's class. If you don't know anything about it, it really explains it very well. Bart McDade, who plays in that at Lehman Brothers, it's funny, I didn't even know who my clients were. I had a lot of managing directors were my clients when I was a rep at Fidelity at the Wall Street Investor Center, and he was like so prominently in that movie, and I was like, wait, I know him. I know Bart McDade, So I was just like, holy moly, So it was real. That was fun. But I think that comes with experience. And what you said earlier about experience, it's really critical. I like to laugh about it and say, I have a lot of experience. Experience is what you get when you don't get what you want. Experience is not good. You want other people's experiences. You want to learn through other people's experiences because they're usually painful. Yeah,
they can lean on your. That goes back to wisdom, right? The wisdom is being able to lean on someone else's experiences, and that's where someone uses it, an advisor. So what right now, as people, there's a lot of uncertainty out there. There's a lot of there's people. Michael Burry made this 1.8. Was it $1.8 trillion bet? Sorry, 1. What's the math on it? Sorry, I'm off on my math.
So here's the thing. It's a massive bet, but here's the thing: is it's not clear. If you don't have to report on that 13F specifically. What the security is. He's got an enormous portfolio, right? And as we all know, he may or may not be on the spectrum. I don't know if that's out there, but he definitely, in the movie, was portrayed as somebody that realized that, like, I'm firing everybody. I'm also going to go to zero. I gated my fund. I'm not going to let them. I know I'm right. And he had that kind of crazy conviction. And so I think that's why this position is scaring everybody. And it very well may be justified. But I also think that he probably manages a lot of money. And these could be hedges against events such as this afternoon's NVIDIA call, which may dislocate the market. If you look at the actual, the charts, not that the charts are, like ever 100% right, but like there could be a 3 to 4% correction before we get some significant support. And this could be that catalyst, or they could kill it and they could still kill it and then have forward guidance that they can't make chips.
Right.
In which case that might send some stocks flutter, but is that really the right event? Is that really the right thing to think about? Is that a distraction from the truth of the $31 trillion deficit that we have? That the gross domestic product is spent on the wrong things? That we're so divided as a country? You know,
Listen, you get in the division of the country.
Yeah,
like,
so let's skip that.
We'll start talking about Hawaii.
Yeah, right. Yeah, exactly. But my point is that like there's a lot of distractions out there. There's a lot of uncertainty, and the market hates uncertainty. That's why you see such a sideways market over a period of a number of years, right? You know, it started here, it went down to here, it went up to here, and now it's here. So, and that's, you know, there have been people that made money, but that are the YOLO crowd right now doing the right thing, you know, or is the sentiment turning against them and that YOLO crowd has spent all their money and the market's going to crater? I don't know. Either way, I don't know. My crystal ball is broken.
Are you hedged either way? And that's the question is, are you prepared as an investor? Are you prepared for both sides of it? And one thing that I didn't sink into me until later in my career was the importance of continuing to build as you've got your investment. You have your investment side of it, and most of us are not investment managers 100% of the time.
It's hard.
And
it's terrible.
You look at it, how much energy goes into that. You hear about people that are trying to micro plan their small, $150,000 portfolio, when if they just focused on, from a business standpoint, increasing the revenue or using an underutilized asset, improving that and getting that up. Just how important that is for, maintaining revenue, maintaining a health of mind as you're going through and building things up, because the market could be going down, but if your overall trajectory as an individual in your business, in your life is up, it's very hard to, it's a lot easier to let that go.
And to ignore everything.
Because you just look at it and you're like, hey, I got up today and my business is better. I'm looking at my metric, I'm running my P&Ls, and I've got this deal and this deal that's popping up, and
which is what you should do, by the way. That's what you should be able to do. Like your job is your job, right? Your job is to earn money in one way, shape, or form. And then your money's job is to earn money in some way, whether it's like, and literally it has to beat inflation, right? $100 today at the old inflation rate of 3% was worth $97 in a year if you added to the savings account, making 10 basis points. Now we have money on the short end, 1-year treasury out, say 4.5%, right? Your money needs to beat inflation, which is currently running at, who knows?
Well, I was waiting for what number you're going to use there.
It depends on it really core services. I'll just say that it's higher than you're going to get in the short rates, right? So I think that inflation's running higher. So you have to be in, if you're saying that your money always has to work, it always has to earn money. The truth of the matter is, just like somebody takes a oil well at a certain price, it doesn't make sense to run that oil well. Same thing with a Bitcoin mine, right? If you have energy that's at a higher level, then you can actually
nobody can tell this is an ace. This is the don't tread on me.
That's right.
With an ASIC at the end of it, but
it's all math, right? It's like at the beginning of the day, if 5 cents is the magic number per to mine,
go profitable,
and to be profitable, then if it's over 5 cents, you're just not going to use it. You're not going to do it anymore. And that's the same thing when it comes to your money working for you.
Yeah.
Like, is your money better off in cash, not at risk? It's not earning, it's not participating in up or down in the market. But when there's such uncertainty in the market, is it wrong to just sit in cash? Because it's obvious that there's the same number of bulls as there are bears, or the market wouldn't be sideways.
Yeah.
And so then you just have to look at what are the potential positives or negative events that could happen? Are there more positive events that could happen or more negative events that could happen? If the thing is positive, then you want to be long. If you think that there's heavier, negative events that could cause these people that wake up every day, that have a job, that are happy and they're productive and they're mission driven, and just want to keep earning their check because they have a fixed budget and they know exactly how much it's going to cost to send their kids to school, to eat, to do all that stuff, that could change on a dime if they get laid off. And that's what we've seen in this recession. They're talking about it being a wealthier person's recession. Luckily, most of those people that have a little bit of money have emergency savings and are able to get by right now. And I think that's what's hiding a lot of the pain
in
the market.
I do. I think the hardship loans from 401ks is up 39% year over year.
Mhm.
You know,
And that's something that
and by the way, all this information is like off of rando stuff off of Twitter.
Yeah, so
That's my news feed is Twitter. So, but
right.
Yeah, no, I think so. You know, going back to it, when you're looking at it from an inflation standpoint, if you're looking for a lifestyle, at the end of the day, everyone's investing you're looking for a better life, and spending so much time wound up on what the perfect move is. I think really, for me, it kind of comes back around to the perfect move is a balance of being prepared for multiple scenarios. And then, you know, am I going to give up some of the upside, or am I going to have to give up, you know, am I going to have some down when other people don't? Yeah, it could be on the portfolio from a numbers standpoint, but then it comes kind of all full circle. If I'm able to build my life and build the business up and things are better overall, and I have people that can, you know, I can consult with that are managing those things. There are some great things out there as far as investment opportunities that are starting to pop up.
Sure.
I just yesterday talked to a family office, and they just purchased a few notes at 50% to par. So, you know, which gives them the juice that they need to get the yield. And you know, they're commercial notes, and they were okay with the risk, and they, you know, with the assets that they were buying, they were perfectly fine just taking those over. And so I think there are some deals like that are starting to pop up. If you're in the know, if you have somebody that has their ear to the ground, and not to knock on Wealthfront again, with their fantastic service for training people to do it, but you need to have people around you that have their ear to the ground and what's going on, so that you can focus on what you're good at from a business perspective.
Exactly. Yeah.
So
agreed.
But no, it's been great. Great letting me on the show. I don't know what the time is on this thing. I feel like you and I can always talk about 1,000 things. I mean, we didn't talk about the disparity on inflation. We could have gone down the path of like, there's different inflations based on what your basket of goods that you're buying.
Really, there's so much content out there on what's going on right now. And if anybody tells you they know what's happening, they're lying. It's like, it's really, there's just so much out there. The one thing that I would love to say, you know, as a parting shot, the one thing that I think is very critical for anybody right now that does have a retirement account in a company that they currently work at, that, you know, whether or not, you know, it's Google, or if it's the smallest, you know, public company on the planet. But if you have a 401k plan, if you have a retirement plan that offers, you know, that you have a substantial amount of your company's stock in because you want to be a good employee, you need to diversify out of that stock, because your job and your equity investment in that company is working at that company. And you don't want a Nortel Black Swan event to happen. You don't want an MC WorldCom event to happen and wipes out your entire equity in your 401k plan because your company went out of business. So that's something that I've actually seen happen personally to a client. I literally diversified out of his portfolio. He owned it all Nortel. I diversified it out. A week later, you know, like, he had changed it back. I didn't know. And then of course Nortel went to zero. And so I told him, I literally called him up all so happy because I'm brilliant, right?
You saved him.
I saved you.
You saved his life. You saved 40 years of his life. Yeah.
And he's like, I put it all back in right after you left.
I mean, what do you say to that? I mean, it's just it just rips your guts out right there.
Yeah.
Because it's a life, it's your entire life savings.
Yeah. And
I think, you know, in 2008, 2009, anybody that was around there, I had a guy that worked with me, you know, early on, and same thing. He had all the stock, and so he was just about to retire. I think he was 6 months from retirement. They had offered him something to, you know, some bonus for staying a little bit longer and extending it out. And really, what they were doing is pillaging his retirement. And so he's 6 months from retirement, and then he lost it all and had to start back over. And I mean, just, I don't know how you kind of recover from that.
Yeah. I mean, we only have a certain amount of time, and that's it. If you don't invest early and invest, you know, like, let's hope you never get into that position.
And you're manager.
Yeah.
You're there for guidance. You're there for therapy if you're walking through things.
Look, when you
to look at it from multiple angles.
When you manage people's money, you are their therapist.
Yeah.
You are everything to them. Tell people about yourself. Tell people how they can get in touch with you. Tell them what you want to.
Yeah, absolutely. We didn't get into it. Working with the Texas Blockchain Council here, helping with policy on Bitcoin mining. A lot of the stuff that we see in the news. Lee Bratcher has been championing, doing some work with on the DAO legislation side, and so really working on that right now. So staying in the one of the unique aspects about the TBC is as businesses are coming to Texas, as miners, we have 17% of the global hash rate for mining here in Texas. So Texas is just a explosion of energy on the Bitcoin mining side. We have 3 times the amount of renewables that the entire rest of the country has combined. So there's just so much that's going on in the energy space and the Bitcoin mining space here in Texas that, there's some unique opportunities. So if your business is building, if you're looking at building if you're looking at building your company here in Texas, if you're looking to take advantage of that, call us. If you're trying to get involved with legislative, on the legislative pieces, if you're a little bit larger. So we have all the publicly traded miners that we kind of work with. And Lee's just done a fantastic job of representing that. So
what I really like about it. So that's, obviously I've gotten involved in going to some of these different meetup events and getting as involved in the blockchain council as I can.
Thank you for the testimonial, by the way. Love the testimonial.
The one thing that I will say though, that I think is the most valuable part of it for any financial advisor out there is to sign up and get on the newsletter, because what happens here in Texas, because we're at the forefront and because Lee is so plugged in on the governmental side based on his military service and his history and teaching, I find it as free research on the crypto side, like what's going on in policy. I think it's critical to know what's going on. Look, may not want us, as Rick Edelman says all the time, you don't have to, as a financial advisor, you may love an annuity, you may hate an annuity, but at least you know what it is and how it works. As a financial advisor, love or hate crypto, you should know how it works and you should know what it is. And this is a great opportunity for free to do that.
Yeah, no, I think on the RAA side, just talking to Rick's team, you have when a wealth manager doesn't understand crypto, they don't understand Bitcoin, they don't understand Ethereum. There's a digitization of assets that's transitioning right now. So 3.8 billion. There's a company here that's a member that's done 3.8 billion in transactions. That's on the tokenization front. So if a wealth manager doesn't understand that, and a family officer, high net worth person calls up and says, hey, what's going on? And you can't answer that question, you run the risk of losing 10 million, 15 million, 20 million under management as they transition that to someone who is in the know for what's happening. So I think, we've got the summit that's coming up in November. Rick's going to be speaking there. He's going to be running the RAA industry track, helping wealth managers and RAAs understand that. And he does a great job of that education point. People should definitely come on out.
I also want to spotlight something else that Lee did that you guys were involved in. I heard that you guys actually worked with Dallas College and you actually have a blockchain crypto, understanding blockchain and crypto. It starts in October, I believe. I actually signed up for the class.
Really? Okay. All right.
And I challenge, there are plenty of money managers here. If you do not know anything about blockchain or crypto, it's not just as a token, but look, I challenge you, go to Dallas County Community College. It's all online. It's a course. It's actually, sponsored by you guys. So thanks for getting that out there. Thanks for providing that education in a format that anyone here in Dallas can do. And if you don't take it this semester, maybe take it next semester, but there's educational resources out there.
And the thing
to learn about it, especially here in the Dallas and Texas area, please reach out to the Blockchain Council.
Yeah, no, absolutely. We want to prepare for this next, 2024, 2025. Technology always, we're always evolving. We're Block and a bunch of different companies that are getting involved. And as a wealth manager, if you miss it out, if you don't educate yourself, you will be left behind because someone will come in. Frank, understands it. Frank's going to be taking all your business. So, certainly jump on in. If there's anything we can do to help out, we're happy to.
Great. Thanks.
Frank,
Well, hey, I appreciate it. Chris, thanks for coming on. Christopher.
Yeah.
Sorry, Christopher. Thanks. Yeah. Let's plan on coming and trying to do this again.
All right. Sounds great, Frank.
Great. Thanks for another episode at Money in the Bank with Frank.
All right.
Hey, thanks for watching The Merge. We've got a ton more stuff for you to watch on YouTube, on Instagram, on TikTok, everywhere. Check us out.